Welcome, everyone. And it is May 9th. Hopefully, you can hear me. It is May 9th, 2023. And we're going to be talking about the all-weather strategies, updating about the global markets and what's going on. I mean, there's so many things going on in the markets these days. Welcome, everyone. Yeah, so... PPSS Sock says, hello, Kun Andrew. Temp or news is hotter. Yeah, actually, it is burning hot here in beautiful Bangkok, Thailand. My mom is burning up. My mom has gone to exercise at Fitness First Gym for the first week, last week and into this week. That's the hot news. Yeah, we've got debt. We've got bank runs. We've got a lot of things going on. We've got potentially a recession now really building up. Interest rates are extremely, basically starting to come down. And as they come down, it's telling us that people are expecting recession. So we've got that. Commodity prices are down, oil prices, so many things going on that we're going to talk about. So I just want to welcome everybody into this to this event. And we're going to be going over the all-weather strategy as well as taking your questions. So make sure that you ask your questions in the chat, and I'll do my best to answer all of them. All right, let's get started, and we're going to go into the presentation and see if we can talk a little bit about what's going on with strategy. Now, my cameras are a little bit messed up today, so you may see I'm going to be looking in weird ways, but here we go. Tisa, good to see you. Nice to see you. Welcome. And also Sak. So welcome to both of you guys and to all the others who are here. So let's try to see if we can share my screen here. Hold on. See if I can do that. There you go. All right. So now we're going to review April's performance. I'm going to switch my camera and relax and sit back and talk to you about that performance. I'm sitting here in my home office. You notice I have a little bit of a soundproofing behind me. Remember, you can ask your questions in the chat. I love the questions that I get here, and we do get a lot of good questions. Remember, our allocation strategies are global, meaning we invest globally, not only in Thailand. They're long-term. The gains from long-term equity returns is what we're trying to get, while trying to reduce the damage during equity market downturns. They're diversified globally across asset classes, regions, sectors, and companies. And again, remember why we are here. Why are we here? Well, we're here to build wealth over the long term. We're not here to invest in some trading strategy or anything. We're trying to set a long-term course for investing that you can feel comfortable and your clients and friends can feel comfortable following. Also, remember a core principle, be broadly diversified. That's a core principle that we want to think about and contribute regularly. These are the things that are going to build wealth and protect wealth as you go through your life. Stay invested. Now, I talk about 12 steps to financial independence, and that's really where this whole thing came about our strategy. Creating a plan, keeping investing simple, starting early, getting real about the returns that you're expecting from the stock market, doing it yourself, avoiding mistakes when you're young, and build wealth through savings and keep your financial costs low, diversify, as we just said, to reduce risk, and own both stocks and bonds, trade infrequently, and stay invested and watch it grow. Those are the 12 steps that I talked about in how to start building your wealth, investing in the stock market, which is what the all-weather strategies is ultimately built on. It's available in both English and Thai at bookstores throughout Thailand and also online. We have an online course at academy.astotz.com. You can ask us more and we can provide that. Now, our goal is to deliver steady returns in the long run. These are our 3 different strategies. Yeah, okay, hold on. Let's see who's here. Someone's here. I'm going to change my camera there. First of all, Yep. Tin, if Japan had stopped using yield curve control, what about your opinion of the Japanese stock market? That's a good question. We're going to come to that in just a bit. And Lato says, hi, Kun Andrew. And then who's this guy? Jessica, good to see you. Good vibes, indeed. Japan is an interesting, situation. I would say that Japan right now, there's so many cheap stocks in Japan that I just think if I was a young person wanting to analyze stocks and pick stocks, I would either be in China or Japan because there's just so much there. But if they stop using yield control, what about your opinion on the Japanese stock market? Well, I would say that ultimately, I think that the Japanese stock market has a long way to go up. It's going to go through some ups and downs, and there's some risk that that some people may perceive a high interest rate environment, and that could happen from the yield control, and that could initially hurt the market. But over the long run, I just think that there's a lot of opportunity in the markets there. All right, let's go back to the presentation here. And so this shows the three different strategies, and we're trying to deliver steady returns. The first one we started off with was the all-weather strategy. Then we did the alpha focus strategy, and then the inflation guard strategy. And we can get a picture of this as we go through, but AWS launched in February 2019 and targets 6% per annum. AWAF launched in October 2021 and targets 8%. And AWIG launched in July 2022 and targets 4%. It's trying to be pretty stable. Those are our goals. And here we can see from when we started, just starting in July 2022, the strategies are performing pretty much as expected over that time. Ranking the strategies by return, we show the highest risk, all-weather alpha focus has the highest return, and the moderate risk all-weather strategy ranks in the middle, and then inflation guard has the lowest volatility. You can see that green line is the flattest of those three lines. Those are our three different strategies that hopefully fit your needs in one way or another. Now, since July 2022, the all-weather alpha focus is above the world equity, and all strategies have had lower volatility. You can see the huge drops in equity that can happen that we tend to avoid over time. Now, we create our strategies for decades. However, not even a decade is a long term. This is me when I was a little baby. That's me when I moved to Thailand, and that's me at 100. So our aim is to create strategies that perform over many, many decades. And we want to present those strategies to you guys so that you can meet with your advisors at Phenomena or just go on Phenomena's site and be able to get access to those so that you can invest for the long term without worrying too much. So we're going to talk about the performance. So all-weather strategy was up 1%. All-weather alpha focus in April was up 1.1%. And all-weather inflation guard was up about 0.2%. And the global outlook that guides our asset allocation is what we'll talk about after that. So let's look at this for a moment. We're going to be looking at the all-weather strategy. And we say that this is global, long-term, and diversified. Now, since inception, the strategy was 7.2% above a 60-40 portfolio as of May 8th, 2023. And here we can see the strategy was about 0.6% above the 60-40 strategy for the month of April. Our 25% allocations to Japan and developed Europe drove that outperformance. We really got those right. Our 25% gold allocation was a drag on April's performance. But, that's how it goes. You're going to have some up months and some down months. So in the past month, the strategy was 1.6% above the 60-40 as of the 8th of May, 2023. Now let's look at all-weather alpha focus. We say that this is global, long tun to a low, global, opportunistic, ha, oh God, and long-term, to yao. So And finally, we say defensive, right? Prom tang rap. So since inception, the strategy was 1.3% below the 60-40 portfolio as of 8th of May, 2023. It's been a rough ride for Alpha Focus, mainly because markets have been down. And so we're just kind of chugging along. Remember, this is also after fees. So I think the performance is okay from that perspective. Also, as far as Alpha Focus, the alternative would be, let's say, to put your money in global equity or world equity, which still would be down to 86.1 at this point. And the strategy was 0.4% above the 60-40 portfolio in April. And it was 0.2% below world equity. Our tilts to world energy, healthcare, and infrastructure did well, while Europe, small cap, and gold has been a drag. Now, in the past month, the strategy was 0.3% above the 60-40. That's as of 8th of May. And 0.5% above world equity. So now let's look at Inflation Guard. So Inflation Guard is global, it's long-term, and it's defensive. Really, defensive is the main characteristic of Inflation Guard. And here we can see Inflation Guard is just flat. When markets are rip-roaring up, Inflation Guard is not going to go up that much. But also when markets are falling, Inflation Guard is not going to go down that much. The strategy has experienced less volatility. And here we can see the strategy was 0.4% below the 40-60 portfolio, meaning 40% equity and 60% bonds. Except for tips, bonds held up well. And our 5% world energy did well. The world equity fund that we're using underperformed the MSCI AC World Index. So that took a little bit of a pain. In the past month, the strategy was 0.1% above the 40-60 as of the 8th of May, 2023. So that gives a picture of where the strategies are at right now. So I want to talk about global outlook and the things that I'm seeing. Remember, if you have questions, feel free to put those into the chat. Let's look at equity for a moment. The 3-month government bond yield has risen to about 5.1% from 2.4 a year ago. And central banks battle inflation while trying to avoid a severe recession or banking crisis, which it seems like is almost unavoidable at this point. We expect higher rates, though, at a slower pace, as central banks haven't yet got inflation down to the target levels. Now, we can see that U.S. and EU inflation have definitely slowed and I think are coming down even more. This has led to a more positive outlook on Europe. And the battle against inflation isn't over. Inflation is less likely to be sticky. And if we don't get a spike in oil, U.S. 2020 year-end 2023 inflation could be down to 3 to 4% by the end of the year, a new normal above the old days of 2% or less. In the long run, equity is the best hedge against inflation as companies have to adapt to survive. So the outlook is that the market has already factored in a Fed rate hike. Now, the market is pricing in a 90% probability of a pause. So actually, they're expecting a pause, but a longer term fall in interest rates. And here we can see the expected rate curve shifted down after the 0.25% hike earlier in May. It's incredible to see what's happening now where the market is expecting rates to fall by 200 basis points. That's a huge fall. The market thinks the Fed will start lowering rates by November of 2023. And besides battling inflation and avoiding recession, the Fed now tries to avoid a banking crisis. That's even more reason why the Fed's going to bring down interest rates. The only thing the Fed seems willing to sacrifice are U.S. jobs, which they're trying to slow down the economy. And if they can, that will also slow down jobs. Now, ECB and Bank of England are expected to get closer to the Fed while the Bank of Japan stays ultra loose. As the interest rate differential should tighten between U.S. and EU, the euro could strengthen against the dollar. Now, this is the inverted yield curve, which is just getting crazy at this point. And the yield curve inversion has dived deeper, and at some point it's going to turn. Now, of course, every recession since 1968 have been predicted by this measure. And if it's right, we're going to see an even deeper recession than people think because of this inversion that's deeper. But also it tells us that we've been inverted for almost 12 months. So the month of June is the month where we should see that the recession starts hitting. So just to mention that for a second, what I would highlight here is that, let's see if I can grab my, not sure what happened to my mouse. There it is. My mouse is acting funny. Hold on. So if you can pull me onto full screen, Coco. See if I can get, there we are. Just to reiterate what's happening right now, what I would say is that we are only a month or two away from the US going into recession. That would be my prediction, and we've been talking about that for a while. Remember, our position in the US market is down to only 5% right now, and we're somewhat defensive at this point. So that is the situation as I see it right now. And I see Ty's there. Good to see you. All right. Let's continue on and let's look at a couple of more things that I think are significant here. Now, for the past year, we've said that we think the course will eventually be reversed and the tightening will turn to loosening. We still think that central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we do think that the central banks are going to break things. We already seen them putting so much pressure on the banking system, which is really starting to crumble, particularly at the regional banks. The recent actions related to U.S. banks support our thesis that the Fed is going to break something. The more you listen to, for instance, Janet Yellen, less so Powell, but Janet Yellen, when I listen to her, I just get scared about what could happen. Let's talk about bonds. Bonds are typically a safe place to be, even though 2022 was exceptionally bad. In recessions, safe assets like government bonds typically have performed well. Though with high inflation, low yields could still lead to negative real returns, but we could be past the peak for inflation and really coming down quite low. We generally don't allocate to bonds to speculate on the upside, but rather to use them to protect capital over time in a stock market that starts crashing. Let's look at commodities for a second. Energy prices have come down. We can see European natural gas has come down tremendously, and oil has been coming down. Food prices have softened, and we've seen that pressure come off. That's good for the world. If the trend continues, it would help to lower the pace of inflation and also get more people food. Commodities have lost momentum as energy prices ease due to a mild winter. We currently don't see a clear catalyst for energy prices to go significantly higher, but think that they can remain high, which supports profits for energy companies. The main upside in commodities would come from a supply shock, adverse weather conditions, or significantly higher demand coming from China. Now, I just wanted to share for a moment my experience in relation to China. What I can say is that I had two people come to see me at my house over the last couple of weeks, and they both came from China. One is an American, and the other one is a Chinese national. And they were just talking about how we're not going to see a strong recovery out of China. And that's because the government has kind of beaten out of the entrepreneurs the spirit to compete, and that really fierce spirit that Chinese have to be successful in business. I find that hard to believe. It just seems hard to believe that that would be kind of beaten out. But if people feel like they're not going to be able to get the benefits of their work, then you've got a point there. But the main thing that I would say is that from that discussion, it kind of supported the point that we could see a slower and a continued slower recovery for China. So let's take a look further beyond that, and let's look at gold. Now, central banks have been loading up on gold, maybe switching from US dollars. Certainly Russia is switching from US dollars. And the recession risk remains. So you can see we still have a gold allocation. And if I grab my pen here for a second, I'm just going to highlight that we've seen a pretty strong rally in gold happening. The question is, can it break out of this level? So we keep a relatively high gold allocation in our strategies, which also serves as insurance in times of uncertainty. And in general, gold price protects the value in times of uncertainty and market downturns. So the key takeaways that I want you to get: first, equities appear more attractive. We overweight Europe and Japan, and we see opportunities to allocate to specific sectors within equity like energy. We buy gold to protect capital. And the risks that I see is inflation reaccelerates, rate hikes crash markets, collapsing energy prices, Europe and Japan underperformance, and falling gold prices. Now, before we get into the Q&A, of course, the Valuation Masterclass Bootcamp number 10 starts on July 3rd, and our super early bird price is still available. And with Phenomena, you can save another $100 extra. You just go to this QR code, or you can go to valuationmasterclass.com and use the coupon code Phenomena to save the $800 that you can save by signing up now. So it's time for Q&A. I'm going to open up the time to have any discussion about any things. So let's see. Do you guys have any questions for me? That is the question I have for you. Let's look at. So we are talking about debt, bank run, etc. One of the things that I was talking with someone today about investing in the U.S. from Thailand, and I was saying the biggest risk that you have now to investing in the U.S., I would say, is the risk of Forex in potentially the U.S. dollar really starting to crash. But truthfully, that's probably not going to happen for a long time, because the U.S. has a lot of power to maintain its position. All right. Now, ABB said debt ceiling is QE, money printing. Yeah, if they raise the debt ceiling, then they would be printing more money. But also, some people think that we're in a QT position, which the Fed has talked about, but actually we've been going into this QE, where we go into what I would call QE infinity. That's the next move that I think we're going to see, is just the QE continue on. We've already seen the balance sheet of the Fed expand, mainly because they are bringing on assets from the banks. Now, if banks are swapping government bonds for cash from the Fed, then it's not money printing per se. But if they're getting rewarded for a discount, let's say a bond, they bought the bond at 100 and that bond is now worth 800, and the government's buying it at 800 and the government's buying it at 1,000. That 800 loss is a QE, because ultimately that's providing additional funding to the banks that they didn't have. So there is some QE aspect of it. But the main thing I care about QE is the balance sheet of the Fed rising or falling? Well, what we saw in QT period was that it was consistently falling. And now what I would say is that it is starting to rise again. And so that is a bit of a concern. Let's see here. Pichit Hongsaranakun Agon. I'm not sure how to say that. But for this week, CPI, PPI, and debt ceiling talk tonight, how will this affect the gold price? Well, again, CPI coming down, and I would expect that it's going to continue to come down. And the debt ceiling, eventually they're going to agree on it, because both Democrats and Republicans love debt. There is nobody in the U.S. that is thinking about, cutting off debt. They all love it. All right. Jet says, what's your thought on set post-election this Sunday? This sounds like a trick question, Jet. I think you probably know a lot more than I do about it. I think it's going to be interesting. I've been asking a lot of people about it. And I guess to me, the election seems to come down to the following. Do you want to give a chance to the new generation and vote for what used to be called Future Forward Party? I forgot the name of it now, but that's the first question. Do you want to give them a chance? Well, then vote for Thanakorn's party. The other question is, do you want to just go back to Pheu Thai and say Thaksin's party, the whole objective of the military coups over the years has been to knock out that party, and it's still there and it's still strong? My one concern is that, if the new generation comes in, that the old generation of politicians may be able to knock them out really easily because they don't have a lot of experience. My expectation for the election, I think we're not supposed to do polls or predictions or something like that, I saw, but I would say that we'll probably see that the party that has been strong despite all of the attacks against it is probably going to come out strong again. I think the one party that looks interesting to me is the Democrat Party. It feels like, could this election be the final nail in the coffin of the Democrat Party? Is anybody voting for that party anymore? I'm not sure. What are they offering the people? That's a question. So I think that the outcome, my biggest prediction probably is that it could be a devastatingly painful election for Democrat Party. Now, as far as the market is concerned, I would say that the market, to me right now, the Thai stock market is kind of neutral when I look at markets across Asia. So it's not like it's super attractive. You've got two competing narratives coming out of the election. I think that Pheu Thai is probably going to win. And if they win, you've got a competing narrative that the people that have been trying to keep Pheu Thai out of power for so long will be so frustrated that they're going to resort to extreme measures. Or it could be that we end up in a situation where people are like, okay, that's resolved. And maybe what we do see is a rise in the stock market after the election. I would probably predict that we will see a rise after the election. Another question, can you explain why Q1 earnings is still good and U.S. stocks up amid recession and the crisis? Well, there isn't a recession yet. That's the answer. The recession hasn't arrived. We can see the demand for employees, unemployment is so low. So the point is, and this is where people, I believe, will get caught off guard, is that they're thinking, where's the recession? There's no recession yet. Still see good earnings and all that. Now, we do see that companies have really, really high net profit margins, and they're not coming down massively. And that, I think, can come down in the second half of this year. As the recession takes hold, we will see prices fall, but also we're going to see costs fall. So I would say that this could be a limited damage to profit margins in this recession, meaning it's just that we probably see that prices start coming down, and we could even see a negative CPI print in the next, let's say, 6 to 12 months. It's very possible that things start falling. I think the biggest problem about the situation is that just when the market and the population is waking up to the fact that we're going to see a big crash or a big fall related to the recession, you're going to have the Fed potentially stepping in and injecting money into the economy. And when they inject that money in the economy, the stock market's going to fly. So you could have a situation where we go into a recession and the stock market starts rising. That's because of QE. Ty says, when do you think Fed is going to lower rates and what will happen to stocks? So I think in the next, let's say, 3 to 6 months, the Fed is going to be facing some collapses in markets, a collapse in the bond markets possibly. And I think a lot of potential trouble could be happening in the real estate market. In fact, that's really where the next problem is probably going to come from, is the real estate market and how that's going to affect these regional banks. The problem that you face in Thailand is that, or in the U.S., if a bank has government bonds, it can trade those government bonds to the central bank and pledge them and get cash. If a bank has mortgage loans for people who are borrowing money for their homes, if a bank has mortgage loans, the bank can sell those mortgage loans to Fannie Mae and Freddie Mac. And the result is they can get them off their books. What they can't get off their books are basically commercial loans to businesses and commercial property loans. Those are not easy. And I fear that what we may see is that we have a case where we start to run into some real trouble with commercial loans. And the banks are holding a lot of them, particularly the regional banks. And I think it's very possible that the Fed could try to come up with some way to buy those commercial loans. I don't know how they could do it at this point. I've just been thinking about it. But if we know that's the crisis area, it's very possible that they try to create a fund or something that they could pledge those commercial loans into. We'll see what happens. But basically, I think the Fed is going to lower rates in the next 3 to 6 months, and that the stock market will potentially fly for a period of time until we get through the excitement of QE infinity happening and then kind of get back to reality. It's such a difficult year, really, when it comes to how to handle the equity market from that perspective, because I think we have a high chance that the Fed is going to get into the market by lowering rates or potentially buying assets like stocks, buying assets like bonds, as they did, particularly in the bonds. They bought those in the 2020 situation, where all of a sudden what we saw was a big blowout in high yield bonds, where their prices were collapsing, their yields were going to the moon compared to just normal government bonds. And the end result of that is that you had the Fed stepping in and buying bonds. And when it did, bond prices started to recover. And then that meant that bond yields started to fall. So that gives you a picture of what I see. All right. Any more questions? You guys are quiet tonight. Not many questions, but I thank you all for the questions that we've had. And our next rebalancing of our strategies is going to come in early June. So look out for that. Soon after that, we'll come out and talk about what's happening and what we're seeing at this point. So roughly a month from now, we'll be back. But next time we'll be back with changes in our strategy. I want to thank everybody for joining this session, and thank you for the questions that you've brought. And hopefully you've got some good information to help you, most importantly, think about investing from a long-term perspective. Thanks, everyone, and it's great seeing you. Have a great evening. Relax. Enjoy the rest of the evening. Take care.